Welcome to the Startup Grind.
All right, so good morning, and actually good afternoon, everybody. Welcome to Startup Grind. A little bit about Startup Grind. We represent 2 million entrepreneurs from 600 cities and 125 countries. And our mission is to give startups everywhere the education, opportunities, and access that they need to build, grow, and scale their company. And these are our values. And when I first saw them, I thought they were pretty corny. And it starts out by, making friends, not contacts, give, not take, and help before, help others before helping yourselves. And when I first saw this, and I've been with Startup Grind for 8 years, I saw it, at the global conference. I thought it was pretty corny. But really, it's been, I think, kind of the reason we're successful. As an entrepreneur, as a community, we offer, we have a lot of talents and a lot of skills. And, for those of you that are entrepreneurs, it's a lonely road. So this is the great place where the community can help each other out. They can give advice. They could walk people. They could talk people off the ledge. So as a community, we're a lot stronger and a lot better. And with that, I am going to give Laura Good, who is the Startup SAC den mother, an opportunity to talk about what's going on.
Yes, and we're going to have a contest to come up with a better name than Den Mother. So
hey, that's what you chose, and
I know I chose it, but I'm getting kind of tired of it. So let me find. Sorry, I need to find the chat. Okay, so I'm Laura Good, and I run Startup SAC, which is a nonprofit that's focused on helping entrepreneurs in the Greater Sacramento region move forward with their startups. So if you want to find out what's going on in the Sacramento region, not just what Startup SAC is doing, but what everyone is doing, I curate an email that goes out every Monday morning. It's called the Sacramento Startup Digest. I posted the link in the chat. You can go there. You can sign up for the digest as well as read the latest issue. So if you want to know if there's something going on here in the next week or two, it's going to be in the Startup Digest. And also feel free to send me your events for consideration as well. So two of the events that I want to tell you about are, one of them is actually being organized by the Carlson Center at Sac State. It's called the Startup Challenge, and it's a weekend event. It's from Friday through Sunday, September 23rd through 25th. And it's kind of like a startup weekend, but it differs in two ways. One, there are cash prizes. Ooh, if you've ever done a startup weekend, that's something that Techstars doesn't allow in a startup weekend. And two, there are two different cohorts or tracks. One is for brand new ideas that have never been worked on, and the other is for ideas that have been worked on. So if you already have a startup and you're in the early stages, you haven't raised any funding yet, then this could be a great program for you. So check that out. Early bird pricing ends tomorrow, the 14th. So I think it's $75 for 3 days, and that includes all your meals. So it's a pretty good deal. The other, tomorrow, I can't remember if it's at 1 or 1:30. It's in the Startup Digest. There is an information session on that. So if you want to find out more about it. And then the other event that I want to highlight, for the first time since February of 2020, Startup Happy Hour, a long-term monthly event, is going to have an indoor, in-person meeting or meetup or event, party, whatever you want to call it. This one will be purely social. We're not going to have a guest speaker. It's going to be at the Red Rabbit in Sacramento, and I encourage you to come out. It's from 5 to 7 p.m., so kind of a celebration of us being able to get together in person again and connect with other folks who are interested in startups. So that's all I've got for today, Rich.
All right, and I'm excited about the in-person event. All right, so here we're going to give an opportunity for actually one startup, and who was that? That was who was it that volunteered earlier? So is she still here? Is that Mark? Laura, are you there?
Gloria.
All right, I'm going to stop sharing. So we're going to give an opportunity
It's
for
Gloria.
Gloria. Oh, Gloria. All right, Gloria. So I'm
Gloria? Yep, I'm here.
All right, go ahead and share, and then you can give us go ahead and share your screen or your video, and you can give us the pitch about your startup.
Oh, sure. All right.
Let's see, for some
So
reason,
yes, hello everybody. Well, I just arrived back in the office, so I cannot really share my screen, but I'm gonna paste you our demo right here in the chat. All right. So what we are is that Merge is a wealth automated app, and our mission is to get 1 billion people towards financial freedom. We have many partners, including Ameriprise, Synctera, and other banking partners just collaborating with us in bringing the best in class financial products. So that way people can get their hands on the best plan possible towards investments and paying off their debt. Historically speaking, the access has not been granted to everyday people. It's only available for the top 1 or 2% in the world, right? So we are opening up the opportunity for everybody to jump on, and we're gonna work with this big guys and fill up the pool, the investment pool, in a democratic way, something like fundraise, but investment model wise. So yeah, that's about it.
All right, thanks, Gloria. Thank you so much. Hey, Wanwani, can you hear us?
Hey, Rich, I can't hear you. Yeah.
Hey, do you up for giving a 30 second pitch or a pitch about Fanalize?
Yeah, I could try. I haven't
All right.
practiced pitching, but
All right, and you just recently, and actually, I'm trying to tout you here. You actually recently won some award or won something, as I recall, right?
no, we haven't won an award.
Or
but,
got into some program. I just remember seeing something on LinkedIn. I thought.
not
This is where
recently.
you make up. This is where you make it up and say, yeah. Okay. Sorry
Juan,
about that.
you've been pitching enough that you should be able to do a 30-second pitch off the cuff.
Yeah,
right?
off the cuff. Yeah, no, it's like the elevator pitch, right?
Right.
So yeah, I could definitely give it a shot. Well, my name is Juan, CEO and co-founder of Fanalize, a sports search engine and analysis platform really to speed up research for fantasy sports and the growing sports betting industry. We speed it up through aggregated data as sports data. We're now growing. We are partners with the top sports betting companies, including DraftKings and FanDuel. We have licenses in 7 states and now generate revenue through subscriptions and affiliate marketing. We're at $6K and MR and plan to double every month for the NFL season. We launch our mobile app and also launching our website soon. So definitely growing with definitely interested in partnering and looking for investment as well. Thank you.
Thanks,
Is that
Juan.
30 seconds?
Yeah. We didn't have to hit the gong or anything.
Oh, okay, good. Definitely need some practice, but thanks, Rich.
And so actually now I'm going to go ahead and just go into housekeeping. So today during the presentation, we just ask you to keep yourself muted. And if you have a question, just type it in the chat, and Gabe will actually address the questions at the end of the presentation. And at the end, you can also raise your hand if you just want to verbally ask the question. And to answer this question, we always get this. This is being recorded, so as soon as it gets done and processed by Zoom, I'll edit it and post it on startupgrind.com. So with that, let me start off with introductions. I'd like to introduce Gabe Garcia. He's been a lawyer for over 15 years, and he's represented nonprofit corporations, including the California Hispanic Chamber of Commerce and United Core Alliance. He's no stranger to startups. He was actually the general counsel for Nutura, which is a cannabis startup that in Sacramento where they obtained like 21 licenses. Currently, he has just launched his own firm, DJR Garcia. And with that, I'm going to go ahead and stop sharing and hand it over to Gabe.
Hi, everybody. I've got a presentation here that I will share, but I wanted to be on screen until we had everybody and we were ready to go. So with that, let me go ahead and share my presentation at this time. All right, well, welcome. Today's presentation is called KISS Safe or Convertible Notes, Understanding Early Stage Financing Instruments. Before I go any further, I thought I'd introduce myself, add a little bit to what Rich just mentioned. And I wanted to point out why I think I'm uniquely positioned to counsel startup businesses. I have a tax law degree. So after you go to law school, if you haven't had enough punishment, and you would like to have an emphasis in a particular area of law, you can go get what's called an LLM, and it's a master's of law. I did that in tax, and I didn't go on to become a tax attorney, but I found it extremely useful in my career to understand tax principles so that I can guide clients, whether they're founders at startups, or I'm doing corporate structuring with subsidiaries and parent corporations, joint ventures, things like that. It's been immensely helpful, and not that many corporate lawyers have that tax law degree, and I found it really useful. I've worked in Silicon Valley as a M&A and a private equity attorney, so understanding how the Valley works as far as financing and some of these concepts, I've done it at the larger scale, and now that I've got my own firm and it's more of a boutique, I am, bringing that skill set to the startup community in earlier stages. I also have experience in a Fortune 100 legal department, which teaches you a lot about how bigger companies work, and is really a goal for all startups, right, to eventually get to that size. And I think most importantly, I've started 3 of my own businesses. I started DJR Garcia last year with my partner, Deborah J. Rotenberg. I have a sort of private equity fund side hustle that I am part of, that I spend sort of my free time working on, and we are seeking funding ourselves right now. And I've shut this business down, but I used to have a side hustle selling Argentinian style barbecues. So that was a consumer packaged goods product, and in a totally different industry than law or tech venture fund, and learned so much about what it means to start and run a business when I did that. So I thought those are a few pieces of pertinent information that I would share today before we dive in now to our agenda for today's presentation. So we're going to look at some early stage financing instruments. We are going to talk about some mistakes that startups make when issuing equity. And then I just want to end with why a professional services team is a must-have. And obviously, I'm particularly biased here as an attorney that is in professional services. But I really do think that there's more value to having a professional services team than the average startup would think. Now, professional services are expensive, resources are limited, but I'll give you some tips at the end on how you might be able to control your legal spend. Or your accounting spend or whatever it might be, so that you can preserve resources but still get the help that you need from advisors around you. So, today we're going to talk about early stage financing instruments, and, I've limited it to the 3 most common. There may be ways that you can seek funding from friends and family with just a simple promissory note you're going to pay folks back. Or you could issue equity right out the gate to friends and family at a certain valuation. But what we're going to talk about now are, the most common forms of convertible instruments that startups are using to get that early stage money. We're talking, there's these labels like the friends and family, and then seed and Series A. And what's interesting is there are some general timeframes and dollar amounts associated with those, but they have changed a lot over time. So what used to be Series A is sort of now a seed, and what used to be Series B is now Series A. So it's all sort of accelerated based on the way that, I'll say, sort of Silicon Valley financing goes. Now that may or may not necessarily apply in a smaller startup environment, but it's worth knowing some of the nomenclature. But let's dive into the basic concept. So the basic concept of a convertible financing instrument is that an investor is providing funding to the company in exchange for a right to convert in the future. And often that is an equity round, what we'll call a priced equity round, where there are outside investors seeking preferred stock, and they are going to work with the company to establish a valuation that they believe the company is worth. And that priced round is what the preferred equity investors will come in at. And that round is really important for these convertible instruments because that's usually what triggers the conversion. So when an equity round is raised and the preferred shares are issued, what first happens is the convertible investor will receive shares first based on whatever the price round is for that investment from the outside investors, and it will convert. So that is an important point because the outside preferred investors don't get diluted. It's the founders that get diluted by these early stage convertibles. And I'll talk about at the end, or rather in the middle, one of the mistakes might be to issue too many of those, because if you do tons of financing through convertible instruments, when there is a trigger to convert, all of that converts before the preferred investors come in. And so it's really diluting the founders and, from their portion of the equity and not from the price round investors. The reason that early stage investors want to get in is that they're first in time investors that get in early, and they're rewarded by having a pretty significant discount in many cases on the price per share for your company. So let's talk about a valuation cap versus a discount. And to be clear, on a lot of these, you can have both, one, the other, or neither. So valuation cap provides sort of a max ceiling of the company's valuation at which the convertible instrument is going to convert. So if you have a convertible instrument and it's got a valuation cap of 5 million, but in the priced round, the preferred investors have valued it at 8 million, the earlier investor holding the convertible note will get a great deal, because whatever their investment might have been, let's say it's $100,000 is going to purchase more of a company that's valued at 5 million than at 8 million. So that valuation cap is the max that the 100,000 will convert into shares. And so they're going to get a better deal than the $8 million preferred investors. Now, if it comes in under 5 million and say it's priced around at 4 million, well, then that 100,000 is going to go even further. So the valuation cap really sets what the convertible investor and the company are willing to, max the purchase of that investment dollars for their initial convertible investment. A discount is a little bit more straightforward. It's merely the discounted rate on a price per share basis that the convertible note holder will have versus the price round investors. So if there's a price round and there's a valuation, and based on the number of shares outstanding, the priced round preferred investors are paying $1 a share and there's a 20% discount, that means that the convertible investors are going to get those same shares for 80 cents per share because of the 20% discount rather than the $1 per share. Now, one thing I wanted to point out, because this has caused confusion with my clients. A lot of you probably have seen the Y Combinator safe. Like the Y Combinator safe is very frequently used, and for a discount version of that, or a valuation cap plus discount, the way that it's written is a discount rate. So you'll see in there, if it's a 20% discount, the Y Combinator version talks about it as a discount rate of 80%. And so my client was like, wait a second, I thought the discount was 20%, not 80%. I said, yes, they're both true. The discount rate, meaning what do you purchase your shares for? You purchase it at 80% of the actual full value that the price round investors are coming at. So when they use the term discount rate, that has to do with what you're buying with, and the discount is what sort of the sale is. You're getting a deal, getting a 20% discount, and therefore you're paying a rate that is only 80% of what the price round investors are paying per share. So in case you come across that Y Combinator, template, and you see that and that's confusing, that's what it has to do with. Now, what if you've got both? Well, if you have both a valuation cap and a discount, at the moment of the price round, you'll have a definitive valuation from the price round investors, and you'll run a calculation on both. And whichever is the lower price, meaning whichever will get the convertible note holders more shares because it's a cheaper price, is what they will get in that conversion. So you would run that calculation both with a valuation cap and a discount, and whichever one gives the convertible investors a better deal, that's what they get. So what are the rationale for using, what are some of the rationales for using the convertibles? Well, there's at least 4 main ones. I'm sure there's a lot of them. But the ones that kind of come to mind for me are, first and foremost, like when you're this early stage, the valuation is really hard to determine. You're getting, your product or services in order. You're assembling a team. You might still just be in the founder stage without having employees, but you need money to hire employees. You need money to do a lot of things. And so without having much infrastructure or track record or data in any way, it's really going to be tough for investors to know how much your company is worth at that time. So, these convertible instruments, do the proverbial kicking the can down the road on evaluation, and they leave that up to outside price round investors that are eventually going to do their homework and really study your company and come up with a valuation. And all of these convertible, instrument holders are riding on the coattails of that because their shares are going to be issued based on whatever that later valuation is. And so this has been a handy way of, getting some very early funding without having to establish any type of valuation. Now, you need to be careful if you're using a valuation cap to not get too hung up on that, because that is just merely a cap. I mean, like I mentioned, you could have a price round much higher than that cap, or you could have one lower than that cap. So don't mistake your valuation cap for your actual valuation at the time that you issue the convertible instrument. Another reason is, this is probably the opportunity for the largest discount. And, sort of 2 and 3 go together. You have this team of believers, friends, family, people that really like your idea. And here's an opportunity for them to get in at the earliest stage and get probably the best deal that they'll ever get for, shares of stock of your company, particularly preferred shares. And so, being able to get in early because you believe in somebody, or they're a friend or family or college roommate, or they've discussed the secret sauce with you and you're like, absolutely, I'm in. And now you can get in and have an opportunity to have the best deal. And lastly, at this point, it's relatively easy documentation. You've got, I mentioned Y Combinator, Startup 500. There's other accelerators that have standardized some of these early stage instruments. And that allows for consistent modeling as well as lower legal and other administrative costs, because people kind of work off the templates. And if everybody knows what the terms are, there might be a few elements that change from one investment to the other, but for the most part, the overwhelming majority of those terms are fairly standardized. And because of that now, it makes convertible instruments a fairly attractive way to invest. So let's dive into some of these. So I kind of debated whether to start with convertible notes or the KISS or the SAFE. I rejiggered them and I said, okay, well, I'm just going to land on this particular sequence because maybe it makes a little more sense, or the SAFE is the most popular right now. So I'll start with the simple agreement for future equity. So simple agreements for future equity are essentially that, right? They are an agreement from your investor to get future equity. And there isn't a maturity date or an interest rate, which we'll talk about in a minute regarding convertible notes. It just is an agreement that says, I'm going to give you money, and when there is a equity round, the next equity round that takes place, that this instrument is going to automatically convert to a number of shares based on a calculation like we just discussed, depending on whether there's a val cap, discount, both, etc. As I mentioned, the price of the conversion is the lesser of the cap or the discount if both are in play. And if a company fails prior to conversion, like it's just, we're going to hang it up, or something happens to one of the founders, and it could be any number of reasons that the company doesn't move forward towards a price equity round, then the investor is going to get a cash payment, essentially getting their money back. That's a downside for a safe investor, which is you've given up your capital for a period of time, didn't happen, you get your money back, but you got no return on it. There wasn't even a simple interest on it. There's also, if there's participation rights, is after the next equity funding round, and we'll talk about that in the pro rata rights in a second. But those are usually something that you find a lot in side letter or pro rata agreements that go along with safes. They aren't required. They're often asked for, and we'll talk about that in a few slides from now. Same with most favored nations clause. We'll talk about that, but it is not standard in safes, but it can be included if it's requested by an investor. It's definitely investor friendly and not founder friendly, so keep that in mind. And then with safes, they can be individually tailored. You really are like issuing those to one investor at a time. And maybe you're just going to offer the exact same terms to each safe investor, but you don't have to. You can mix it up. Often the very, very first safe investor will want a better deal than later safe investors, which is why the most favored nation clause comes in, or at a minimum, the participation rights, but it can be tailored to each situation.
Gabriel, this is Laura. I'm breaking the rules and have a question. If you wouldn't mind going back to the safe slide. It says that if the company fails prior to conversion, the investor gets a cash payment that is equal to the safe purchase price. What if the startup doesn't have any money left?
Then it's going to be treated as probably a junior debt holder. Like if there's a convertible note holder that has an actual liability, it really depends on the sequencing. that may first be considered if there's zero money, then everybody's just out, right? That's why you form a corporation where you don't have personal liability to owe investors anything. If there is IP that's been developed, but there's no money, that IP may be able to be sold off, and then all of the safe holders or note holders, whoever is holding some form of an instrument with your company, is going to get a pro rata piece of whatever the sale of that IP is, but you're basically moving in to liquidation and dissolution, and the investor's probably going to be left holding the bag, and you probably are going to have a tough time raising money in the future as a failed startup founder. Just that's something to consider.
Okay, thank you.
So the next one is a KISS, and I honestly haven't done as many KISSes. This is a keep it simple security. It's really kind of a spin-off on the safe. Came up a few years ago. It could be an equity KISS. It could be a debt KISS. It's sort of a blend of the safe or the convertible note. It usually has slightly different terms. One of the more salient terms that it usually always has is a specified threshold for an equity round. So the KISS will convert to preferred stock as soon as an equity round of a new investment above that threshold occurs. So if it's a $1 million threshold and you get a price round investor in at $2 million, great, that's going to convert. If you've issued a KISS, and I'm talking like, okay, we're doing a $25,000 KISS, and then later you find a priced investor that is willing to come in at 500,000. That's not going to convert. It hasn't met the threshold yet. So the KISS holder is going to keep staying a KISS holder until you get to a later round of equity financing that exceeds the threshold. Here, you often have an ability to receive a cash payment or a conversion into common stock if the company fails prior to conversion. Again, practically speaking, I don't totally know how that would work. If the companies fail and have no money, then there's not a whole lot to give out. So these often would come up in a failure context where it's not a failure because there's no money, but because like a major founder is left, or there's a big fight and founders leave and it's going in a different direction, but there's still money in the company, there's still value in the company. They try and steer it a different direction, liquidate it, etc. So there's a slightly different result if there's a company failure. The participation rates are in all future equity funding rounds. And that's interesting because it gives you the right to continue to buy in the future to maintain your percentage of equity in the company. And we'll get to that in the pro rata rights. And in a KISS, it is typically extended to all future rounds, whereas in the safe, it's just the next round. The most favored nation clause is pretty standard in KISSes. And in the KISS instrument, all the terms are identical. You basically have this and you issue it out, and any KISS holder is going to have the exact same terms. So it makes it a bit easier at conversion to know exactly what would happen with a keep it simple security conversion. So then let's also talk about, we'll call it the old school instrument of convertible notes. So before the safe and the KISS were developed, there were convertible notes, and these are convertible promissory notes, really. And what's interesting about these is that they are a hybrid instrument between debt and equity. So they start off as debt, and they have an interest rate. And the interest rate accrues from the date that the money is given until the maturity date. And so, there might be a particular dollar amount for the investment. There's going to be interest And then depending on the maturity date, that note becomes due and payable or convertible. And so, the convertible notes carry a maturity date. We get to that date, or there is a priced, there's a priced round prior to the maturity date, which will then convert it. And some notes have an automatic conversion at maturity if you haven't had a priced round. And in that instance, you're going to have, the automatic conversion is going to necessitate a valuation at the maturity date between you and the convertible note holder. There can also be a scenario where the convertible note holder gets to choose whether to convert, although most convertible note holders want it to convert. They don't, if they wanted to give a loan, just a straight loan, they would have done that. But they want the equity, but they want something in exchange for their money being tied up. And that's the interest rate. That is a sort of a creditory interest in the company until they become an equity holder. And so the convertible notes, they act much the same, but they have a few more hooks in them that are investor friendly because they're sort of a ticking clock with the maturity date. If you don't have a priced round, the maturity date comes, you owe the money back plus interest. And if you can't pay it, then it's a default. And the convertible note talks all about what happens in the event of a default. So it acts very much like debt. You need to be really careful with them, but you can use them effectively with the right types of investors. And I'll talk about the convertible note purchase agreement. I'm doing one of these for a client, and this is a concept where it is a convertible note, but rather than going to each individual note holder and getting each and every convertible note approved by your board, and then issuing the same or varying, varying terms on the convertible note, you have your board approve a convertible note purchase agreement where folks are going to purchase equity in a convertible note by some standard terms. And this is sort of like the KISS debt version. So you might, so an example would be, okay, we're gonna approve a $2 million convertible note purchase agreement. The board approves that one time, it's out there, and now the corporation can issue multiple promissory notes, convertible promissory notes to investors at a different time. And then you've got a schedule of who came in at what date for what amount of money until you hit $2 million, and then it's closed. Like that subscription to the convertible note purchase agreement is now closed, and that's the max that you're gonna offer is $2 million under those terms. And if maturity comes and you got to pay it back, then there's a, like a prorated calculation of the interest. So if somebody came in for $500,000 on day one, then you have another $1 million, a year later, and then 6 months later, there's another 500,000. Obviously, the interest rate is not going to be for the entire, say, 2-year maturity period. It depends on when you came in. But what it does allow is for your company to seek up to $2 million with a series of notes, all identical terms. You get a simple promissory note signed by each one. They get the main convertible note purchase agreement with it. And then you can do some interesting things if there's still room in your subscription. So to use my example, if it was a $2 million convertible note purchase agreement, and it's a 2-year maturity date. If you're at the 18-month mark and you only have, say, 1.5 million subscribed, there's 500,000 you can still take. Now, maybe you're talking to some priced round equity investors, and you're discussing valuation. So this thing is going to convert pretty soon. And it, as a company, as founders, you want it to convert. You really don't want to have that note and all the interest due. So you might make a deal with the priced equity investor and you say, hey, listen, you want to come in at 5 million. why don't, a $5 million investment, why don't you take the first 500,000 and fill up the rest of the convertible note? Because you're going to get either a valuation cap or you're going to get a discount, and your first 500,000 of investment is going to get you even more shares. And then your other $4.5 million investment will be at the priced round. So it does give you a little bit of a sweetener if you've got room in your subscription with your priced equity investor. So there's some real benefits there. And then for the investor, like I mentioned, they at least have a creditory interest, and they're earning interest income on their investment in case the investment fails, or in case they don't quite get to a priced round in time. There's a little bit of an upside for the investor. And the other thing is that I have seen in those instances where, and really in any convertible note, the interest accrues. So that gets added on to the investment at conversion. So if you had $100,000 investment in a 5% interest rate, and 1 year, then it's going to be $105,000 that they get to convert their investment into shares at, because it was $100,000 of principal, it accrued $5,000 in interest. Now they're going to get $105,000 worth of shares. Now, often those instruments say that the company can pay the interest only and keep nice round numbers for converting the equity. So, that's just a small detail that's interesting. You can either have them purchase $105,000, or you can, have them purchase $100,000 and pay them back the interest only in cash. And usually convertible notes contain both most favored nation clauses and pro rata rights. So let's talk about those, since those seem to be coming up quite a bit. So the most favored nations is, I find it really funny that this nomenclature made it into equity financings for startups, because it's really comes from like the UN and other international treaties. So like most favored nations is like just a term that got carried over into startup financing, which is really interesting. But it means that if a company is issued additional notes in the future with better terms, then this first in time investor gets those better terms. So you gave a 20% discount to your first safe holder, or your first note holder, and then a year later you issue another one with a 30% discount. If that first holder has an MFN clause, they actually going to get the better deal. They're going to get the 30%, not the 20%. So, there's pros and cons as to why you might use that. It is a sweetener for investors. It does cut into your ability to, get the max price per share if you're giving an even bigger discount later on, because the folks earlier that didn't have that discount now are entitled to it. So kind of cuts both ways, and you would want to use that sparingly, but there's some times when that's just what the investor might need to make the investment, so you offer that most favored nations clause. Pro rata rights are also called participation rights, and it's a right that is included often in convertible securities, where the investor is allowed to invest additional funds during the next priced round. And normally it's at the priced round price. So if I go all the way back to my example and there's a 20% discount, it's $1 per share, and the convertible instrument holder gets it at 80 cents per share. They get their initial investment at 80 cents per share, and you do that full equity issuance. And if they're holding, say, 5% after converting their note, then they have the ability to maintain their pro rata equity interest, that 5%, by buying at $1 per share, enough shares to keep a 5% interest. So it's sort of an anti-dilution provision for early convertible note holders that lets them buy in. They do have to pay full value that the price round investors are doing, but at least they know that they're not going to dip below that, say, 5% equity interest by having the next equity investor come in. Now, typically, other than the KISS, that's only at the very next round. You don't get that each and every time. But you might have a savvy investor say, I want pro rata rights through every equity financing, which would mean even if you got to Series C, and it's a much more expensive. Now it's $5 a share or what have you. They can buy that at $5 a share and have the right to participate and purchase more of your shares. So you also have to make sure that if you've got pro rata rights, you have to make sure you have enough stock authorized so that you can account for a pro rata rights holder exercising that right and being able to buy even more shares to maintain their equity interest. So, I wanted to keep this particular presentation high level around the concepts, but there's a lot of resources out there to show exactly how the conversion of these instruments work. And, a big portion of it is understanding the cap table. Like, what are the issued and outstanding shares that are already out there and issued to your founders, your employee team, your advisors. The number of shares out there really is what drives how these convert, because when you get a priced round, you're going to come up with a per share price, and that's going to determine whether or not the valuation cap or the discount it applies, and what the convertible instrument holder, what their price per share is. But you won't know any of that unless you know how many actual shares are in this realm of the calculation. So, I had put in some slides and I was like, well, we could really get into the weeds here. And I don't think that's what this presentation is for. And there's a lot of resources out there to get examples. I think one of the best one is Kirsty Nathu's presentation at Y Combinator. I included the link in case you want to check it out. It's like a 55-minute presentation just on safes and how they convert, and gets into many more details than my presentation does. So there's a transcript and there's a video from her presentation. In the video, you can see she has various slides that if this, then this, and if you've got pro rata rights and they're able to purchase, how many more shares would they get to maintain the equity percentage. Really goes into a lot of detail. And so I highly recommend that presentation as sort of a corollary to this one if you're trying to get a better understanding of the mechanics and how the actual conversions might work around specific dollar amounts or share amounts, etc. So I offer that to you. I'm also happy to provide greater detail in a complimentary consultation should you ever wish to reach out. I just felt like I wanted to keep it high level today, and hopefully those concepts are helpful in understanding the differences between some of the convertible instruments that are out there for startups to use for their financing. So let's talk about some mistakes. Because I've been practicing law for over 15 years now. I've been a corporate lawyer for most all of that, and I have worked with a lot of clients, and in so doing, I've kind of identified some errors that early stage founders can make when when seeking financing and when running their companies. So the first one is not being due diligence ready. And as somebody that does due diligence in the M&A capacity and the private equity capacity, this is really important. The devil is in the details. But I can't tell you how many times I've worked with clients and they're ready to issue some form of equity financing instrument, and the investor says, hey, can I see, your bylaws, or can I see, some of the, your policies and procedures, or can I see, your resolutions, your board resolutions that have authorized you to even have the corporation issue this convertible instrument. And they may or may not have done those, but they may not even be signed. Like I've seen them where, oh yeah, we've got them. We pulled some template, but there's placeholders still in them. They aren't signed, or they've got them and they're hard to find and they're not delivered in a timely fashion. And I really feel like this is totally within your control, having all of this stuff ready to go, organized. Maybe it's already in a data room so you can share it with your investor. There's a lot of strategies to have your company be due diligence ready. And I think it's a massive case of first impression, because if you can't even quickly deliver accurate, fully executed documents in your early stage financing to investors, they may question whether you have the attention to detail and the ability to carry out this entire venture to make the money. So I really think this is one that gets overlooked a lot more than you would think. And it's like fully within your control, especially if your team is still small and you don't have a lot of people that you need to go get signatures from. You don't have a large board that's hard to meet and approve these things. I mean, unanimous written consent resolutions are really useful, because then you don't have to, if you need to approve issuing a safe, your board really should be approving that, because you're giving out future shares. It is a security. It does need, you are talking about having to be exempt from securities filings by meeting one of the federal and state blue sky laws through Reg D, 25102F in California. So there is a good amount of compliance that's needed there. And all of this ties into being due diligence ready. And, like I said, if you are organized, let's say you're not working with counsel, fine. Somebody on your team needs to be responsible for this stuff. And if you're trying to build a product, or you got a dev team, you guys are coding all night, it gets kicked down the road. And, when you've got an interested investor, because now you're out there pitching, you've got a rich uncle who's like, I'll invest, but let me see your stuff, and you can't deliver it, can really set you back. So this is one mistake that, like I said, very avoidable. So get organized and be due diligence ready. The next is not reading legal documents. If you don't have legal counsel, you should be reading every word of every legal document you're signing. Even if you don't know what it means, if you're smart enough to be starting a startup and asking people for tens or hundreds of thousands of dollars or millions of dollars, you're probably smart enough to read through a document, take notes, research it on your own, ask your lawyer friend, whatever it is. If you're not using legal counsel, it's practically a breach of fiduciary duty to just be signing or issuing documents that you haven't read. And even if you do have legal counsel, you shouldn't simply rely on the attorney's advice without having a conception of what the documents do. You can absolutely rely on your attorney's suggestions. You can believe that the attorney has put together the best version of that instrument that you want. But if you really don't even know what the instrument does, you're kind of flying blind. I mean, you are responsible as a founder of this company for, its well-being. And if you're not investing the time to understand, financing documents, which are critical to your company's success, then you're doing yourself a disservice. Two, you're not going to understand the nuances as you get later into financing. So if you can't be bothered to read a 3-page SAFE, what happens when you get to Series A and there's anti-dilution, ratchet rights, and all these other, hooks that savvy, preferred investors have and demand? They're sort of building blocks. So knowing the early stage stuff that's easier to understand will help you understand later when the deals get more complex. And if you're not reading it because it's boring and it's legalese, that's fine. You're just running a major risk of kind of looking like you don't know what you're doing. Even if you have a lawyer there on your team, in-house, outside counsel, guiding you, you're the founder. You represent the company. You are a chief officer probably in some way. So you kind of owe it to yourself to be reading these legal documents one way or another. Another mistake is issuing too many convertibles. So convertible investment instruments are extremely handy for early stage financing. But there has been a trend with their popularity for issuing lots of them. And if they have different terms, because one's a valuation cap, the other's a discount, one of them has both, all of these different deals that you've given out there, they're just sort of a ticking time bomb, not necessarily in a bad way, but they are going to convert at some point. And if you don't have mastery of understanding exactly what it means for the dilution of your equity, you are doing yourself a disservice, because it's coming out of your end as the founder and not out of the priced equity investors. Like, all of these convertible instruments convert right before the priced round investor comes in, because now you've got the shares in hand. And then that leads to the total issued and outstanding shares, which is what's going to then drive, based on the valuation from the price investor, what the price per share is. So all of those get converted, then the equity investor comes in. And so by issuing lots of convertibles, you're just really taking equity out of your own pocket. Now, it's necessary in many cases to get that early stage financing. I mean, you may not have a choice, but it doesn't mean that you need to raise all of your money for the first 2-3 years this way. You might raise some of it with a target of, okay, once we've raised X amount of dollars through convertibles, we absolutely have to move towards a priced round, because we don't want to keep kicking the can on valuation. We don't want to keep diluting the founders. So let's set some benchmarks for ourselves so that once we've reached a point where we feel like we've had enough early stage funds, now we'll go seek out a priced round and do, what startups do, which is pitch for equity investors and then convert everything. And now after that conversion, now you really have like a robust cap table. You've got your founders, the common stock, typically with common stock. You may at that point have your incentive, your employee stock option incentive plan, and set aside, incentive stock options for employees and advisors. Then all of your early stage convertible instrument holders are going to convert, and they're going to have their set of preferred shares. And then you'll have your price round investors come in, and now you'll really have like a really good conception of what your cap table is looking like. And that's going to set the stage for any future priced rounds as well. And you're kind of off to the races there at that point. But knowing when to kind of turn off the faucet on convertibles is a really key point in time for early stage companies. So to keep that in mind and don't issue too many convertibles. And lastly, cap table misrepresentation. Like, there's a temptation, especially with valuation cap convertibles, to say, okay, well, they gave me $1 million for a $4 million valuation cap, so it's going to be like 25%. But what happens if it converts lower than that? It's going to be more than 25%. So because the conversion to shares depends on factors that are unknown at the time that you issue the convertible instrument, you can't really put it on your cap table. Now, you can explain to outside investors or anybody who's asking the question, well, what notes are you holding? Whether they're convertible notes with an interest rate and a maturity date, or a SAFE or a KISS, you can explain how much you've raised on those convertibles, but you really don't know what that's going to mean for your cap table until the conversion happens. So you got to be careful about considering those people already on your cap table because you haven't converted it yet. Maybe you'll never convert. Either way, it's a mistake to try and take a guess. It's really not advisable because it's a guess. You don't have all the information needed to make the calculations. So don't do it. Just kind of explain in aggregate what you've raised, or you can tell them how you've raised it, under what types of instruments, but you don't really know how much equity they're going to take down until we get to a conversion stage. So that's one of the other major mistakes that I think is worth avoiding for early stage companies. So let me conclude the presentation with a discussion of the importance of a professional services team. And the reason that I'm making this pitch, or if you will, this presentation today, is because I see, a lot of startups try to do this themselves. So I'll start with legal counsel as an obvious one. Most startups just refuse to justify the spend, thinking they can do these things themselves. They've got Y Combinator templates, etc. But would you perform your own medical procedure instead of using a doctor? Probably not. I mean, doctors are licensed in medicine. Lawyers are licensed in law. You're talking about needing to meet securities laws, as far as federal and state securities laws compliance. Have you studied that? Do you know it? Do you know that you could be violating those if you do it the wrong way? Have you ever paid a finder's fee to a broker or an advisor that connects you with an investor? If you have, now this isn't typically, this typically isn't a risk for the company, it is for the broker. But if you have an individual that's influential, that has contacts in the industry, has wealthy friends that are willing to invest, and they put you together and you agree to pay that individual either in shares of your company or in cash for brokering the deal, that person needs to be a registered broker-dealer because they are brokering securities. And that person needs to have certification and licensure to broker securities. And if they don't, they're in violation of the law, and the company itself, excuse me, is getting money from investors based on a deal that really has violated the law. So these things happen, and when I tell clients about it that have started to use me, they're like, I had no idea. I'm like, there's a reason that you had no idea. We're trained in this. This is what we know. We have read through the boring fine print, and we're here to give you advice on how to run your company and raise money for it in the most compliant fashion possible. And so I really urge startups, when the time is right, to be utilizing legal counsel, like maybe even from the get-go. I mean, I've seen articles of incorporation written in a way that needed to be corrected, or bylaws, or not even having a board having met, even for initial resolutions to approve getting a bank account, or naming additional directors, or giving out advisor shares. Like, these things need to go through a board. Maybe that board is just a single founder. Maybe it's all 2, 3, 4, 5 of the founders until investors come in and demand a board seat. But as a board member, as a director of the corporation, you have fiduciary duties under the law to make sure you're following certain protocols and meeting what California or Delaware corporation law says that you need to do as a director of a corporation. So this is where utilizing legal counsel can, help you avoid a lot of those pitfalls. And frankly, you can move some of these tasks to them if you're super busy trying to run a company and you don't want to have to like deal with the legalese. That's what legal counsel is for. So it doesn't go unnoticed by me that lawyers are expensive, no doubt. So, I have tried to take the temperature of the market, especially for early stage companies, and understand what the pressure points are. How do we price things that could make it worth a young startup's spend for legal? So, negotiating a flat rate or project-based legal engagements will help you predict your legal spend. A lot of law firms will also pend their bills. So they'll say, okay, we'll just track hourly billables until a later date when you get that seed round or the first safe over 500,000 or whatever it might be. You're kicking your legal bill down the road, but in order for law firms to take that risk, they build in risk protection by typically having higher rates. They may charge much higher rates because they're not going to get paid for 6, 12, 18 months. So yeah, we'll do the work and we'll pend the bills, but it'll cost you in our hourly rate. I really tried to move away from that. I like working with companies at a very early stage and say, hey, what if we got you everything you needed to issue your very first safe for, a set amount of money? That way, and maybe you pay a portion up front, and then you pay the other half of your flat fee after you've got the safe converted. Now you haven't expended too much, very predictable. You pay half up front and the other half when it's closed. You've got the safe money to pay that second half. So you really have to be thoughtful about your legal spend. But if you find the right lawyers that are willing to work with you and be an early stage partner, then that's the best of all possible worlds, because you're getting the professional help you need with a predictable spend, or at a time when you can actually afford it and you have the cash to pay for those invoices. Another indispensable member of your professional team is an accountant, CPA. You have to have them on your team, whether they're internal, somebody that, like maybe it's your CFO with an accounting background, or they're external. But I, like I talked about at the beginning, I have a tax law degree, so I feel very comfortable speaking with accountants and CPAs about stuff because I understand accounting principles. Not every lawyer does. And certainly non-corporate lawyers, it's like they don't even try it with them. But for corporate lawyers that do have that background, they can work hand in hand with your accountants. You've got the 409A valuation, which is the section of the Internal Revenue Code that says when you are issuing out your incentive stock plan, that you're talking about stock options. So there's going to be a strike price. So you can't have a strike price unless there's a valuation done. Now, maybe that's not your Series A price round valuation. It is an internal valuation needed in order to give a particular value to your your incentive stock options for your employees, say. So 409A valuations can be done by a business valuator, can be done by accountants, but you can already see the accounting portion early on come into play. And then you also have to remember, if you're a C corporation, as opposed to an LLC or an S corporation, which is a pass-through, then the corporation itself has its own tax reporting obligations, separate and apart from whatever the founders and stockholders' tax liabilities and considerations might be. And so you're going to need to be filing a return each year, even if it's a zero return, or if you lost money because you've expended it, but you haven't brought any revenue in yet, fine, there'll be losses. And those losses can be carried forward for a certain amount of years, should you start making money in the following years. But that whole piece of your accounting and how it makes it onto tax returns is something you need an accountant for. And again, it's one of those things where those people are specially trained and licensed to do so. So find them make sure they understand your business, make sure that they can help you. And a final example of that is and this is less for the corporation and more for the founders. And that's the 83B election. So if you are receiving restricted stock and you want to make that 83B election as a restricted stock recipient, there's tax consequences to you at a future date. And the 83B election allows you to mitigate those by taking in the value of and paying the tax on the value at the date of grant when the stock might be worth very, very little versus later on if you were to sell it and having to value it at that time. Thankfully, accountants don't have the same ethical, I say thankfully, but like an accountant can probably counsel both the founders on what the tax liability might be for them individually based on their tax income rate or them and their spouse, and also counsel and provide accounting advice to the corporation itself. So even though those are two separate parties, we're just talking about accounting, whereas we as lawyers, we really either need to represent founders or we need to represent the corporation, and we can get waivers, but only one of them is our client unless they both agree to waive that conflict. So it's a little bit different with legal ethics than it is for accountants. So you might seek out a CPA that's willing to both do the C Corp returns and give advice to the corporation, and in the early stages, help the founders understand their own liabilities with respect to the equity that they're receiving and what the consequences might be from a personal tax standpoint down the road. And then, lastly, other professionals. So I'd ask yourself, are you working in a highly regulated space? And if so, specific consultants may be needed. I mean, I think about health tech, med tech, fintech, canatech, like all of these auxiliary tech products or services that service the healthcare, financial services, cannabis industry. You kind of have to know what the regulatory framework is in order for your product to not create an issue under the regulations. I'll give an example. One example is there's a lot of companies out there doing biometric data. So take like a Fitbit or something like that, where you have, they're a tech company and they're gathering data around health. Well, some of those pieces of information are what are called protected health information under HIPAA. Now, a health tech company is not a covered entity under HIPAA. They don't have an obligation to protect this information and have all the HIPAA protocols under federal law because they're not like a hospital or a medical provider that is a covered entity. However, if you're operating in California, the Confidentiality of Medical Information Act has more stringent provisions than HIPAA that say that if you are a healthcare platform and you're gathering the equivalent of HIPAA data, you may have obligations under state law that are similar to HIPAA that you never would have thought of because you don't consider yourself a medical provider. But guess what? You're using technology to gather medical data around people's age, date, their weight, any number of types of diagnoses that absolutely need to be protected. And if you just consider yourself, a data company, you may not be thinking about that. So finding consultants that know those regs that can tell them to you so that your product is compliant or helps your partners using it remain compliant is really key. I guess, the last point for the presentation that I would make is that don't look at this team of professionals as a cost item to be minimized at every turn. I understand that a lot of early stage companies, their primary focus is having resources to sink into dev, having their dev team build out a minimum viable product, having that minimum viable product make them attractive to larger investment amounts. That's absolutely probably the best spend, but it shouldn't be your only spend. You should consider these people your partners to help mitigate risk and, honestly present a professional quality to your company so you don't just look like a bunch of ragtag investors that are, bootstrapping everything, it's like, well, wait, this company has a lawyer, they have an accountant, they have this consultant, and put them on your pitch deck. It strengthens your team, even if they're not one of your employees or somebody you use that often. Leverage them as a partner that's helping you try and achieve the same goal, even though their services may be expensive. So as you work through budgets, as you work through the best use of spending the investment dollars that you're receiving during your fundraising, keep that in mind. So with that, I will end on questions. I saw a bunch of stuff popping up in the chat. So I guess I'll leave it up to Laura and to Rich to fire away. I'll stop sharing my screen and we can just have a chat on some of the questions.
Yeah, so if you have a question, you could either raise your Zoom hand, or we're a fairly small group. You could unmute yourself and ask your relevant question to Gabriel. I think most in the chat was chatter from me, but someone, Gloria, did ask about if you have a checklist or one-pager guide for early stage startup founders to refer to from time to time.
Yeah, what's the best way to get that out to the group, Laura? Would you like to have that so that you can distribute it and have it in the future? Or I do have that.
Yeah, I think if you sent it to me and Rich, then we can, Rich can distribute it to people who registered for this event through Startup Grind channels. And then I can also use it as a resource for Startup SAC. There was also a question about whether or not your slides would be available. Rich, do you have a way on Startup Grind to share the slides if Gabriel's interested?
I think so. Yeah, I think there's a spot where I could actually upload this slide deck.
Okay, so what I'll do is Rich and Laura, I'll send you both my checklist and the slide deck, and then however Startups, Grind is best able to get that out to the registered members of this group and have available for others that may come across your site, by all means.
Okay.
Hey, I actually have a question, Gabe.
Okay.
So as, I'm starting my next startup, how much should we budget for professional services? I can kind of see the wisdom of it, knowing that, startups don't have a lot of money, but, if they could, how much should it say in general budget for professional services?
Such a good question.
Probably depends a lot on the industry.
It depends on that. It depends. I want to say like, well, what about 10%? But what if it's 10% of $10,000? Okay, that's not very much. If it's 10% of 10 million, great. I think it's less in terms of a set amount. And what I would do is I would pick a number that you think would be acceptable, and then go to the professional service providers and say, hey, this is our budget. How do you charge for your fees? What are they? Based on my budget, is there any wiggle room there? Can we do something flat rate? So it'd be hard to give like a specific number, but I do think you should try and figure out what's like the absolute max you would spend on it, and try and get under that by talking to your professional service providers. It's not the best, most satisfactory answer maybe, but.
So in terms of maybe the order of magnitude, should a startup budget, 3,000, 5,000, 10,000 for?
Okay, well, I'll give you, a good example would be, it's sort of a loss leader for us, but we'll do incorporations for a flat rate of $2,000. You say, oh, I can go on LegalZoom and do that. Yeah, you could, but my checklist has 13 things that you need to be fully compliant to get your corporation from an idea to a fully formed and issued, corporation, at least in the state of California. Delaware, a lot of corporate lawyers will also practice in Delaware because so many startups start in Delaware because that's where the traditional, VC investors want you to be in Delaware. So either way, there's a lot there, and not all of them get caught by LegalZoom. And if you are doing Delaware, one of your extra steps is if you're California based, because you are here, but you want the benefit of Delaware law, and so you're forming under Delaware, now you got to register to do business here as a foreign corporation in the state of California. So there's a good amount there. We'll do it all like flat rate at that amount. You know, I haven't. So that's just one thing. If you haven't even gotten the corporation started, now let's say you've got the corporation started, and you're going to do, you know, your first, you know, financing of some sort with a SAFE or a convertible note. Then, you know, that's another project that you could get quoted out. I would say the priority would be making sure that you get formed properly the first time around. The second is, if you're going to take other people's money, it changes everything. You know, the founders are going to put in their own cash or sweat equity, fine. But the minute you start taking other people's equity is when it becomes really important to make sure that you're using the right advisors to do it the right way.
I have to tell you, Gabe, I wish I had met you earlier, because I just paid like $5,000 to set up my Delaware C Corp. So, dang.
Yeah, I mean, I will say that's not an unfair price. We do it. I offer it as an exceptionally low price because, number one, it's good training for my young associates. Like, at this point, they're pretty good at it, but they are able to do it at a flat rate. That way, if it takes them a while and I have to review their work, etc., none of that is on the hourly rate. It's just you get it all for a set rate. And we do that so that you can see the quality of our work, and then, you know, you'll continue to use us going forward. That's how I try and give, you know, early stage startups a break to demonstrate our value, and in the hopes that you'll keep us along as a partner as we keep going forward.
We got a question from Renee. Renee, you want to go ahead and unmute?
Hi, Gabe. Thank you for a great presentation. How do you feel about forming in the state of Wyoming?
Yeah, Wyoming has been an interesting new one. To be really clear, like, the reason that corporations form in other states purely has to do with shareholder lawsuits, right? Because if you are operating your business here and you want to have customers here, or you got employees here, what have you, you're going to need to register to do business as a foreign corporation, no matter where you incorporate. Now, if there's a lawsuit from shareholders or an investor, that is where the state law comes into play a lot more. So, you know, right now, I mean, Wyoming seems to be like the hot new state, partly because it's kind of has so little corporate case law, and it seems to be very corporation friendly. Delaware is the most established, so all the huge companies and, you know, like the Fortune 100s, they're all there because they have their risk is magnetized if they're, you know, if they're not in that state and they're subject to another state's laws. So I think Wyoming is very easy and a good option, but it doesn't get you out from necessarily California tax if you've got folks here with a nexus to the state, or from the obligation to register your business here as a foreign corporation.
Okay. And I have one more question, I'm sorry. And do you do IP work in your office as well?
You know, we'll do a little bit of trademark searching, but that's, you know, like getting trademarks registered. That's probably the extent. I mean, IP is a very specialized area. I didn't, you know, I could have talked about that at the end. IP is a special subset of legal counsel that, if that's important to you, you should absolutely seek out IP counsel, because it goes sort of beyond our capabilities, beyond getting your mark maybe registered in the state or at the USPTO.
Thank you. Thank you.
Okay, so there's a question in the chat from Julian. What legal considerations, if any, must consider a startup when setting a valuation for conversion to a convertible note?
So let's see, what, if any, valuation? Well, I think the key thing is always like making sure that your valuation cap, in the conversion is what you would be willing to give up if it converts at the cap. So in other words, if to use the $1 million investment with a $4 million cap, that means you are willing to give up, at a minimum 25%. It could be more if you don't get to that cap with a price round investor. So you want to find a sweet spot that is, okay, I'm willing to give up that much equity to the convertible note holder, but that also can be a bellwether for the actual price round investor who's like, well, they've got a valuation cap here at 4 million. Maybe that's actually what they're at. So I'm going to come in at 4 million. I'm not going to come in at a $5 or $6 million valuation. I'm going to come in at 4 because they haven't done much since they issued the safe. They issued the safe at a $4 million valuation cap. So they must think that their company is approaching a $4 million valuation. Why would I go any higher? So it's this interplay of understanding how much you're willing to give up equity-wise to the convertible note holders and what that valuation means to other later price round investors. Hopefully that answers the question.
Okay, so it's last chance to ask a question. Anyone have a question before we wrap up?
So just one last question, and this is I get this question from a lot of startups. Is like, they're really early stage, and there's people that are interested in investing them, but then it raises the question of valuation, and how much should they, do you have advice around that?
Well, to the extent that you can work with, there's a number of ways. You can value your time. If you're a founder, you can try and come up with what you think is a rate for your time. And are you doing it full-time or part-time? And did you used to be a consultant somewhere charging $150 an hour for your time in your prior job in a past life? Maybe that's how much your time is worth. You start figuring out how much time you spent on this, you're sinking that in. Your IP, do you have proprietary IP that you think is unique? That's tough to value, but it's worth something. Could you go to a 409A evaluator? You don't need a 409A evaluation now, but maybe you establish a relationship with a business evaluator and you get sort of a sneak peek 409A evaluation as if you were going to need one tomorrow, and you might have to pay for that, but then great. Now you've got sort of a sneak peek valuation from somebody that does this, can kind of look at your assets, look at the space you're in, how competitive is it, have other similar competitors had investment recently and at what valuations and at what stages, then give you an idea so then you can plug that into your own valuation cap negotiations.
Okay. All right. Anything else? Any last final statements there, Gabe?
No, I don't think so, other than I really appreciate the opportunity for Startup Grind having me present. The materials will make it out to the group, and if anybody needs to reach me, all my contact info is included. Okay.
Hey, and Gabe, thanks for taking the time to present today. I know for startups, this is, I wish I had heard your presentation a year ago when I was starting actually, I wish I would have met you a year ago before.
Well, that's what Startup Grind's all for, right? It's for people to hear it now.
Right. So
be able to think through these and then reach out to find the resources they need.
So thank you very much for presenting. And then I got this question a couple times. As soon as we get the Zoom rendering of the video and I edit it out, we'll post the recording. And thank you for taking your lunchtime to spend with us, and have a great day.